Good day, everyone. Trust you're doing well today. Today, we're talking about mistakes nobody wants new investors about in the Nigeria stock market. So, have you ever noticed something strange about the stock market? Now, two people can buy stocks at the same time. One person builds wealth over the next 10 years, and the other person loses money, gets frustrated, and eventually quits investing altogether. Now, here's the interesting part. Many times they bought the same stocks. So, what happened? Was one person smarter? Did one person have secret information? Not necessarily. The difference is usually much simpler than what people think. The successful investor understood what game he was playing. Meanwhile, the unsuccessful investor didn't. And if you are investing in the Nigerian stock market today, this might be the most important lesson you will ever learn. Because the biggest mistake new investors make is not buying the wrong stock. It is not investing at the wrong time. It is not even following bad advice. The biggest mistake is something much deeper. Most beginners treat investing like gambling instead of business ownership. And once that happens, almost every other mistake starts showing up. Let me explain. Imagine two friends, let's call them Tunde and David. Both have 500k to invest. Both open investment accounts. Both are excited. Both want financial freedom. But guess what? They approach the market differently. Tunde enters the market with one goal: make money fast. His question is, which stock will double next month? Not next year, not in 5 years, but next month. Immediately, he starts searching social media. He joins WhatsApp group, Telegram group. In some cases, this set of people actually go on, Naira Land to start asking some funny questions. So he follows people posting screenshots of profit as well. Every day, he sees someone claiming they made huge returns in the stock market, and slowly he begins to feel something dangerous, which is, fear of missing out, FOMO. And you know what FOMO does? FOMO will make you have this feeling that everybody is making money except you. Now, let's look at David. David asked a different question, such as, if I'm buying part of this company, is it actually a good business? Notice how different those questions are. One person is looking for excitement, the other person is looking for value, and that difference changes everything. Now, most new investors usually think they are competing against the market, trying to beat the market. Well, that's not really the case. Basically, what they don't understand is they are competing against human psychology, especially their own psychology. The market is full of people making emotional decisions. Some decisions could be rational, some decisions can be very, very irrational. People become greedy when prices go up. People become fearful when prices go down. And because human emotions never change, the same mistake happen again and again. Let's look at a simple example. A stock rises 30%, nobody pays attention. It rises another 50%. A few people start talking about it. Then it doubles. Suddenly, everybody wants it. Social media is discussing it, especially on X, Twitter. Friends are discussing it. People are posting profit. Now, the crowd rushes in. But think about what just happened. Most of them fail to realize that the early investors bought when nobody cared. But unfortunately, the late investors bought when everybody began to talk about the stock. And very often, the people arriving late become the buyers that early investors dump on, which is sell to. That is one of the oldest stories in investing. Yet it happens every single year and every single time. The funny thing is that when prices are rising, almost everybody feels smart. Especially in bull season, everybody turns out to be a good trader during the bull run. So basically, this is one of the biggest trap in investing. People start confusing luck with skill. A rising market, which is a bull run, can make almost anyone look like an investing genius. But the real test comes when things stop going up. And eventually, trust me, they always do. Now let's go back to our two friends. A few months later, the market becomes volatile. One of Tunde's stock dropped from 100 naira to 85 naira. Immediately, he becomes nervous. He begins to check his portfolio every hour. He reads negative comments online. He starts imagining the worst case scenario. He comes on Naira Land to ask some funny questions about should he pull out or whatnot. He goes on Twitter, on X rather, to start asking questions due to him being nervous. Then eventually he sells. But guess what? He failed to realize that he didn't sell because the business changed. That's the business of the stock he was holding, right? He also didn't sell because the profit of the business collapsed. No. Again, he didn't also sell because the company became worthless overnight. However, he sold because the price moved. And this is where many investors lose money, especially beginner investors. They focus entirely on price. Now, successful investors focus on businesses. Think about it this way. If you own a supermarket on your street, would you panic because someone offered you less money for it, this week than last week? Probably not. You would look at the business itself and ask yourself, are customers still coming in? Are sales still growing? Is profit improving? That is how business owners think. And that is exactly how investors should think. A stock is not just a number moving on a screen. It is ownership in a real business. The moment you understand that, your entire approach changes. You stop asking, what stock will make me rich quickly? And you start asking, is this company creating value? That one change can save you from years of mistakes. Now, let's talk about another mistake many new investors make. They know stock symbols, they know share prices, but sadly, they don't know anything about the actual companies. They know a stock trades at 50 naira, but they don't know how the company makes money. They don't know whether profits are growing. They don't know whether debt is increasing. They don't know whether management has a good track record. That is like buying a car without opening the bonnet. You are making a major decision based on surface information. Before buying any stock, ask yourself a few simple questions like, how does this company make money? Is profit growing? Is debt under control? Does management make good decisions? Has the company treated shareholders well over time? You do not need to be a financial expert. You just need to be curious enough to understand what you own. Now, there's another lesson that many people ignore: dividends. A lot of beginners only focus on share price appreciation. They want stocks that move fast. But some of these strongest wealth builders, understand the power of dividends. Because wealth is not only created when prices rise. Wealth can also come from cash paid back to shareholders. And over many years, those payments can make a huge difference, especially when they are reinvested. This brings us to another major mistake, which is putting all your money into one stock. Many beginners become, convinced that they have found a perfect company. So they put almost everything into one stock. But here's the problem. Even great companies face unexpected challenges. Government policies change, exchange rates change, industries evolve, competition appears, management make mistakes. No company is guaranteed success forever. That is why diversification exists. Not because it is exciting, not because it creates headline, but because it helps you survive. And survival is one of the most underrated skills in investing. You do not need every investment to be a winner. You simply need to avoid the mistakes that destroy your portfolio. Now, let's take a step back and just look at the bigger picture. Nigeria has a growing population. Technology adoption continues to increase. More people are gaining access to investment platforms. Financial awareness is improving. This trend could bring more investors into the market over the coming years, but opportunities and risk always exist together. Inflation remains a challenge. Interest rate matters. Government policies matters. Global economic condition matters as well. Nobody knows exactly what the next 5 years will look like. And that is why successful investors focus less on predictions and more on preparation. Instead of trying to predict every market movement, experienced investors do something different. What they do is they cultivate a strong habit. They manage risk, they diversify, they stay patient, they continue learning. And most importantly, they remember what game they are playing. Because at the end of the day, the stock market rewards the patient far more than excitement. The people who usually win are not the people searching for shortcuts. They are not the people chasing every odd stocks, right? They are not the people trying to get rich next month. They are the people quietly buying good businesses and giving those businesses time to grow. So if you remember only one thing from this video, remember that the stock market is not a betting shop. A stock is not a lottery ticket. A stock is ownership in a business. And the moment you start thinking like a business owner instead of a gambler, your decision begin to change. You stop chasing hype. You stop panicking over every price movement. You start paying attention to fundamentals. You become very patient. You would also become disciplined. And over time, those small changes can completely change your investing results. Because in investing, getting rich slowly is usually how people get rich eventually. And that's a lesson most people only learn after making expensive mistakes. If you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.